What's up everyone? Thank you so much for tuning in. And if you are new, welcome to my channel, where we try to cover topics that are of interest to you on real estate and mortgages. So please make sure to like, share, and tap that bell icon so you get notified anytime I share an informative video. And of course, if you find the information provided is of value, then all I ask you to do is to hit the subscription button to get me motivated to keep you up to date with everything real estate. Hi, my name is Preeti Rao and I am both a real estate and a mortgage broker for close to 20 years. Today, I'm here to answer the frequently asked question, how to understand a credit score. How do credit scores work? And most importantly, how to increase your score in Canada. Stay to the end as I do cover some very good tips on credit practices that'll help you with your credit score. So, before we dive into the details, you have to know that there are two national credit bureaus, Equifax and TransUnion, and they both are equally important because these companies collect consumer data from a variety of different sources like financial institutions, your public records, etc., and they produce what we call the credit report. Credit scores drawn on information found in credit reports and is calculated through careful analysis from information in your credit report to arrive at a 3-digit number that ranges between 300 and 900. Of course, the higher the three-digit number, the better your score. So how is a credit score calculated? It's affected by 5 factors: payment history, credit utilization, credit history, credit mix, and credit inquiries. So let's start at the bottom. First is the type of credit used. Even though this part of your credit score makes up to 10% of the total score, it is the least significant part, unless you don't have much other information on your credit report. Creditors are always interested to see if you have experience in handling different types of credit, because that sheds light on how you handle your money overall. For example, a deferred interest or payment plan can indicate that you are not able to save up for the purchases ahead of time. Consolidation loan means that you are having difficulty paying your debts in the past. Note, even though the credit scoring system looks for different types of credit, you shouldn't go around applying for different types of credit to try to improve your score. That does not help. Only open credit accounts as and when you need them. This part of the calculation is in place to help identify people who tend to abuse credit or people who apply for every credit card that comes in the mail. If you focus on being responsible with your credit, this part of the scoring system is most likely to just take care of itself. Second factor, new credit. This part of your credit score also makes up for only 10% of your total score, and it is the second least significant part. Frequently applying for new credit can signal financial difficulty. It's called credit shopping, and it does not reflect favorably on someone's credit. This part of the calculation takes into account the number of times your credit has been checked in the past few years, the number of credit accounts you have recently opened. Let's see, how much time has passed since you opened any new accounts, and the time since the most recent credit inquiries. This part of your credit score will also evaluate whether or not you have re-established your credit history following any past payment problems. Now note, every time you apply for credit, your score does get dinged a little. So before opening a new credit account, it's smart to consider whether having that extra credit is worth the drop on your credit score, especially if you're applying for a mortgage or a new car. Third factor, length of credit history. This section of your credit file details how long your credit account has been in existence, and this part of your score makes up to 15% of your total score. If you have had credit available to you for a long period of time, your credit report should provide an accurate picture on how you use it. Time is needed to get a true picture of how responsible someone is with their credit. Now note, do not be afraid of getting new credit. Just don't keep applying for everything and anything. And once you apply and get the credit, then let time and proper credit management from your end do its bit in bringing your score back up again. Factor number 4, amounts owed. The second largest component is the amount that you currently owe relative to the credit you have available. Credit score formulas assume that borrowers who continually spend up to or above their credit limit are a potential risk. Lenders typically like to see what's called as a credit utilization ratio below 30%. This is the percentage of available credit that you actually use. Though this calculation focuses on your current amount of debt, it also looks at the number of different accounts you have opened and a specific type of accounts you hold. When you apply for credit, the amount of consumer debt you owe really matters to the lender. If you are close to maxing out on all your credit cards or your line of credit, this could be a sign that you are in financial distress, and it means that you are a large risk to the lender. Please note, large amount of debt from many sources will have an adverse effect on your score. Avoid maxing out the credit cards. Show prudency in managing your debt. That will help you build your credit. Finally, the most important factor and the number one component that calculates your credit score is your payment history. This makes up the remaining 35% of your credit score. Your payment history is the most important factor as it takes into account all payments on all your consumer debts, your credit cards, your line of credit, your car loans, your student loans, etc. Your credit report payment history will look at how many accounts you have that are paid as agreed, how many past due payments you have, whether or not you have any adverse public records or collection activities, or any late payments. Your credit history will also detail how many of your credit accounts are delinquent in relation to your overall account. For example, if you have 5 credit accounts, also known as trade lines, and you've had late payments on 3 of those accounts, that ratio will impact your credit score. Another factor that tends to be ignored are the public records. This includes any kind of judgments or bankruptcy, collections, even family responsibilities. They show up on your public records, and no AAA bank is going to lend you money unless you pay up those public records and make those records all clear. This is the reason why payment history bites off 35% of the calculation. Now note, if you have taken money out of your credit card or your line of credit, please see to it that you do not extend over 30% of your limit. And if you do, because life happens, make sure that you bring it down to a balance of 30% when it's time to pay that bill. But if you're not in a position to do that either, then make a little bit more than just the minimum payment. But no matter what you do, make that payment. These 5 factors discussed here are also not the only things that are important when you apply for credit. Lenders will consider other factors as well. They will look into your income, your assets, your liabilities, how long have you been at your job, and what's the reason for applying for this credit. Also note that factors outlined applies to majority of consumers, but it doesn't apply to everyone. When you are new to the country, you start with a good score, and then it keeps moving up or down depending on how you manage your debt if you have new credit. Then the credit scoring system will weigh these factors a little differently. Now for the bonus. Here are some good common sense practices that will help you with your credit. Pay your bill on time. Well, even if you cannot pay it in full, please make sure to make a little bit more than just the minimum payment. Second, watch your credit card balances. Make sure you're not using too much or all of your available credit. 3, don't mindlessly open new credit card accounts. If you're applying for new credit cards, make sure that you don't do so too frequently. This behavior makes you look irresponsible to creditors. Next, check your accounts online. In today's day and age, there's no reason to wait for the bills to come in the mail. You should make sure cards are being kept current and up to date. Next, pay off delinquent bills. Paying down delinquent accounts won't remove missed payments from your report, but it can make you look better to creditors. Lastly, look for inaccuracies. Sometimes information reported to the credit reporting agency isn't quite right or it's incomplete. It's up to you to let them know this, because remember, credit bureaus are just the messengers. They report the information provided to them by your creditors. So, if you found value and you liked this video and would like to see more content, click on the boxes on the screen. Once again, my name is Preeti Rao. My contact information is in the description box below. And make sure to like, share, subscribe, and hit that bell icon so you don't miss any future videos. Thank you so much for watching, and don't forget to call me because I hold the key that opens the door to your dream home.